Hey guys, and welcome back to another video. In this video we will be analyzing gold, and today we will be incorporating some retail trading concepts to see why most retail traders struggle when they blindly follow these ideas. And more importantly, I will show you how you can combine these retail concepts with the ICT concepts to maximize your trading edge and make better informed decisions. By the end of this video, you will understand how to avoid common retail traps and use a smarter approach to trading. So, as you can see, we are currently looking at the gold on the 15-minute time frame, as you can see it here. And from the chart here, I was expecting a lower prices and to target the sell side, which is this one. And you can also notice that we have 3 sell sides here and 2 buy sides, which I didn't point them. This is the buy side and this is another one, which is buy side. Now, the most majority of retail traders would look to buy at this stage. And based on my experience, there are a few key reasons why this happens. First, when you see an aggressive, which is this one, aggressive upward closing candles moving quickly toward the higher prices from here to here, a lot of traders automatically assume that the market will keep going up. However, I personally avoid buying after such a moves because it is when the majority of traders jump in and think that the prices would go to the higher prices, this is where you have to think that the prices will go to the lower prices. And even though you would think that it is a continuation, or this was a retracement and then a continuation, this is where most of traders face a problem with, and they lose maybe their capital, or they enter a drawdown. So you have to avoid thinking the way that retail traders think, because that's often when the market stabs the retail traders and start to go against what other people, or like what the majority of traders think. So now let's drop into the 1 minute time frame, and I will be explaining this setup in more detail. So now, as you can see, we are on the 1 minute time frame, and this is where the London session starts. Here you can clearly see a falling wedge formed, which according to the retail traders, it is typically considered as a continuation pattern to the higher prices. And this is exactly why so many traders rush in to buy in this situation. As I mentioned earlier, when the market has a strong bullish move with big green candles, which is on the 15-minute time frame, I mentioned them before, like 3 minutes I guess, many traders assume the trend must continue higher. However, this is where the experienced traders comes in. You have to question whether the market is genuinely moving higher or if it is stepping a trap, and understanding this difference is really important. Now, this brings us to the London session, which starts at 2 a.m., which is here. At this point, I expected prices to drop toward this order block, and I thought it is a key level. However, I forget to mention the imbalance or the fair value gap on the 15-minute time frame, and I will show you now. As you can see, I forget to mention this 15-minute fair value gap or inverse fair value gap on the 15-minute, which played a crucial role in the price movement. As you can see, where price straight to this fair value gap or inverse fair value gap, and to be honest, I was expecting the prices to go to the order block, but there is like a difference which is 10 pips, and my expectations was slightly wrong. The reason it was Thursday, if it is Wednesday I would expect the prices to go to the order blocks, but it is Thursday And from my experience, the prices respects the inverse fair value gaps or the fair value gaps in general much more. With that being said, even though price did not reach for the order block that I was expecting, it did respected the inverse fair value gap. But the important question is, what time this happen? When it comes to the macro time, you should know that the main window is from 250 to 1030. I will write it down here. 250 to 310, the main one. However, another important time frame that most traders overlook is between 150 to 210. If you observe closely, the price, which is here, starts to move to the higher prices and reaching for the inverse fair value gap between 150, which is here, to 210. And this is where the prices start to do some points or some give us some opportunities where the prices is more likely to go. And at this point, I saw a solid opportunity, which is this one. This is a fair value gap, and after overlapping it, became an inverse fair value gap. And I was waiting for the price to break under this inverse fair value gap after tapping into it. And this is where I entered targeting the lower prices, which is, I guess, I exited here. And as you can see, the price went to the lower prices perfectly and tapping into the sell side, and this also this sell side. Now let's discuss why market did not respect the falling wedge, even though in many cases like this pattern do lead to higher prices. And this is a key concept that many traders misunderstand. So the main reason price didn't respect this pattern lies in where the sell side liquidity was positioned. If you analyze the chart carefully, you will notice that sell side liquidity was very clearly defined. Many traders fail because they do not properly identify the liquidity levels, meaning they don't know which direction the market is more likely to move toward. And this is a critical mistake that leads to unnecessary losses. And this is where experience plays a huge role. And it is also one of the main reasons why most traders struggle in the markets. And many traders start their journey without a real understanding of price moves, and instead of learning the deeper machines of the market, they blindly follow generic concepts without proper validation, and they believe that they just recognizing a pattern is enough. But that's simply not how the market works. A lot of traders, for example, assume that whenever they see a falling wedge, the market will continue higher. But that's not always true. Now, does this mean that the falling wedge is useless? No, it is not. It can work. But really question is, when does the falling wedge work? For example, when you see the market forming a jagged movement, what do I mean by that? For example, when you see the market forming a jagged movement, you need to analyze whether there has been a clear market structure shift after market has taken a sell side liquidity. For example, when you see the market forming a jagged movement, you need to analyze whether has been a clear market structure shift after the market has taken the sell side liquidity or the buy side. Because a strong market structure shift after clearing the liquidity is a major signal that the price could reverse and respects the pattern. However, if the market leaves the sell side untouched as this situation without showing any jagged movement, then it is unlikely that the pattern will hold. So what do I mean by jaggedness or a jagged movement? For example, let's see here. This is a buy side and the buy side has been taken. You see how the prices start to has like a jagged movement or jagging, where it's like the ICT called it as a shark teeth, where the market just show you a way of jagging. All right. So then the market did a market structure shift here, and then it went to the lower prices. But here you see the market did a falling wedge, and a lot of traders think that it is a continuation. But when you see the sell side is so clear like that, you will notice that the prices will go against the falling wedge and go to the sell side and take the sell side liquidities. And this is exactly why the market didn't respect the falling wedge at this session, because there was no proper liquidity grab followed by a confirmed structure shift, which is as you can see it here. Instead, the price continued as a drawdown move respecting the sell side, and we had already identified this move, and we already identified before the fact that this move will happen. And as you can see, the prices did went to the lower prices. So that's it for today. I hope you found this analysis insightful, and that it helps you to refine your trading approach. If you have any questions, feel free to leave them in the comments, and I will be happy to answer them. So thanks for watching, and I will see you in the next video.